I know that you're tactically overweight short-term equities versus bonds right now. Explain that to us.
So, first of all, thank you for having me on. We switched our tactical allocation to actually reduce our equity exposure to bonds. But let me be very clear here. On the fixed income side, we actually reduced our duration. We sold our longer-term fixed income instruments, and we're sitting closer and hugging the yield curve a little more. We do anticipate there will be an inversion of the yield curve over the course of the next 6 months as Jerome Powell decides to raise interest rates an additional 1 or 2 more times.
All right, so, it's out there. You're saying that the curve is going to flip. Now, usually, traditionally, historically, when the curve flips, it's pretty accurate foretelling a recession about 12 months down the road, right? So that's a year. And what the market does, what equities do is, look, they kind of try and price that in 9 to 12 months, what is likely to happen 9 to 12 months down the road. So does that mean that this market is in for a correction, if not worse?
Yeah, I think it will eventually have a correction. It may be a little later than everyone's expecting. An additional headwind is the reduction of liquidity from, of course, the Federal Reserve as they reduce that balance sheet. That also is equivalent to a rate hike. But again, I think also what we're seeing here is you basically have a massive amount of fiscal stimulus that's hitting over the next several quarters. So that will mask any type of deceleration. Really, when the inversion of that yield curve happens, it actually disincentivizes lending from banks in the United States because they actually get their cost of funding from depositors.
Still watching? Perfect. Click here to watch another great video from CNBC International. Oh, and don't forget to subscribe. Thanks for watching.